If you have a significant pre-tax balance in an IRA or other retirement account, there's an excellent chance at some point in your life you're going to be subject to something called required minimum distributions, or RMDs. This occurs when the government forces you to withdraw money from your pre-tax retirement accounts once you reach a certain age. These distributions then increase your taxable income and possibly your related income tax. And as you get older, these distributions as a percentage of your account balance get larger. But few people understand how RMDs work, how they're calculated, and how the withdrawal amounts as a percentage of the account balance change over time. And if you don't understand them, they can be incredibly hard to plan around. But that ends today, because in this video, we're going to discuss how RMDs are calculated, how RMDs change over one's lifetime, and how they can impact your retirement. But first, allow me to introduce myself. My name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. I release new videos weekly, so if you enjoyed this content, please hit like or subscribe, and you'll be notified when the new videos are available. Before we dive in, let's have a quick primer on RMDs. RMDs are the IRS's way to force you to take distributions from your pre-tax retirement accounts. You can put money into your pre-tax retirement accounts and get a deduction in the year you make the contribution. As the assets grow within the account, they are allowed to grow tax deferred. However, because you received a tax benefit when you put the money into the account, the distributions are taxable income when you take the money out. Now you're probably thinking to yourself, sounds like an easy enough problem to avoid. I'll just never take money out of the account. Unfortunately, it's not that easy. If you do not take distributions from these pre-tax accounts early enough, you'll be required to take annual withdrawals from these accounts. Those forced withdrawals, after a certain age, are called required minimum distributions, or RMDs. And these distributions are considered taxable income in the year in which they are taken. We can contrast this treatment with Roth retirement accounts. No tax deduction is allowed when contributions are made to a Roth account. However, once the account has been open 5 years, you can withdraw both the contributions and the earnings on those contributions completely tax-free. Now, this is an admittedly oversimplified summary of these retirement account types. And with most things related to tax, there can be some complicating factors. Sometimes seemingly small changes in fact patterns can have dramatic effect on the tax treatment of any transaction. So just know I'm painting with very broad strokes here, and this should not be considered specific advice to your situation. This video is for entertainment and educational purposes only. For the purpose of this video, we're going to discuss RMDs from accounts where the account owner was the original contributor. Things can get exceedingly complicated when IRAs are inherited. So for today's purposes, we're only discussing original owner IRAs. So how do you calculate the RMD? Well, here's the formula. Basically, you take your ending balance in the prior year in the IRA, and you divide it by your distribution period. Okay, so prior year ending balance of the IRA seems easy enough to find. You can probably just grab your December IRA account statement and use the ending balance on that. But what about that distribution period number? Well, remember, in this video, we're going to focus on RMDs where the account holder was the original contributor and owner. Given that scenario, people generally use Table 3, or the Uniform Lifetime Table, which is released by the IRS in Publication 590. The people that should use this table are the following: unmarried owners, married owners whose spouses aren't more than 10 years younger, and married owners whose spouses are the sole beneficiaries. This is what the table looks like. Please note the two columns. One is the age, and the other is the distribution period. Now, the distribution period is also sometimes referred to as expectancy factor or life expectancy factor. You know, as if taxes aren't complicated enough, let's go ahead and call the same thing by several different names. But I digress. So this is where the distribution period number from that first formula we saw comes from. Okay, so let's run through a calculation. Let's say we have a $1 million pre-tax IRA at 12/31 in the prior year end, and the owner is age 75 in the current year. So if we do the calculation, we see $1 million divided by 24.6 gets us to a distribution amount of 4,650. Pretty simple, right? Now you know how RMDs are calculated. But let's go one step further. Let's see what happens to RMDs as people get older. Let's say we have a $1 million account balance, but we're going to take RMDs at different ages. Here's an exhibit of our calculated RMDs based upon a $1 million account balance at different ages. As you can see, as we get older, the RMD as a percentage of our account balance gets larger. Now you're probably saying to yourself, well, okay, but nobody's account stays at $1 million forever. And that's a very valid point. But if you do have a sizable IRA account balance, at some point in time, you're going to be forced to take larger withdrawals as you get older. So let's think about what those larger distributions could do. From a tax planning standpoint, these larger distributions could do two things. Put us in a higher income tax bracket and put us in a higher IRMA surcharge range. And another thing to consider, as you take larger RMDs, you may not be spending all the money that you are taking out of the retirement account. If that's the case, chances are you're reinvesting that money in a brokerage account, which may create even more taxable investment income. Now, I think we all can agree that this isn't a bad problem to have, but it can be a problem nonetheless. So what are the takeaways? Number one, as we get older, we're going to be forced to take a larger percentage balance of our IRA every year via RMDs. Number two, these larger distributions could force us into higher tax brackets and IRMA surcharges. Number three, as we take larger RMDs, we may begin to accumulate a larger amount of assets in taxable brokerage accounts. This could create more investment income subject to the higher income taxes. And number four, this highlights the importance of Roth accounts. Doing Roth conversions earlier and at lower income tax rates will not only reduce the amount of RMDs we'll be forced to take later on in life, but it will also accumulate the assets in Roth type accounts, which are not subject to taxation during our lifetimes. Additionally, our beneficiaries will be able to delay taking assets out of a Roth account for another 10 years, resulting in even longer tax-free growth. It's important to take a lifetime view with taxes, especially when you take RMDs into consideration. Doing strategic Roth conversions either before or during retirement can have a dramatic impact on the taxes you pay in retirement. If you've done very well being on autopilot and have accumulated large balances in your pre-tax retirement accounts, know that at some point in time, the government is going to require you to take distribution from these accounts via required minimum distributions. And at that point in time, it may be too late to do anything. So try to be proactive as early as possible to reduce the effect that RMDs can have later on in life. Accumulating large balances in Roth accounts is a great way to avoid RMDs. If you'd like to learn more about when to do Roth conversions, I did a video on Roth conversion opportunities that may arise during your lifetime. You can find a link to that video here. If you've made it this far, thanks for watching. If you like this content, please hit like or subscribe. Thanks again for watching, and we'll see you next time.